The popularity of index funds has absolutely exploded over the last 20 years, with its AUM going past $15 trillion as more and more investors are now switching towards investing passively with index funds. And the reason for this is clear. Index funds are simple to understand, have low fees, offer broad market exposure, and most importantly, are able to outperform both active fund managers as well as average investors over the long term. But if everyone is investing in index funds, can this create the biggest stock market bubble the world has ever seen? Michael Burry, the hedge fund manager who famously predicted the 2008 market crash, said this: "The difference between now and 2000 is passive investing bubble that inflated steadily over the last decade." So is he right, and will one day see the index fund bubble burst and cheap boom? Or are index funds still a smart and safe bet for long-term investors? Alright, let's start with the basics. What is an index fund? An index fund is a type of mutual fund or exchange-traded fund that tracks the performance of a market index. He's speaking the language of gods. Okay, I know this sounds confusing, but it's actually quite straightforward. An index is just the ranking of something. It could be an index of the richest people in the world, an index of medals won in the Olympics, or an index of the richest countries in the world. And yes, Singapore is way up there. In the investing world, the most famous index would be the S&P 500 index, which holds the largest 500 companies in the US, sorted by their market cap. Then there's also the Straits Times index, which holds the largest 30 companies in Singapore, also sorted by market cap. The market cap of a company is equal to the total number of shares multiplied by the stock price. So, for example, if Apple releases an Apple car that can fly to space and shoot laser beams, its share price could double in value, which also means their market cap has just doubled. Or if Tesla does a robot event but fails to provide any concrete details of what they are going to do, their share price can drop 9% overnight, which was what happened. So as the stock's market cap goes up and down, it automatically goes up and down the index as well. So that's an index. And index funds are just funds that invest into the holdings according to their weight. For example, when you invest $100 into the S&P 500 index fund, you'll be investing $7.13 into Apple, $6.79 into Nvidia, all the way to 1 cent into some companies that you may not even have heard of. And here, you'll see the first potential problem. Right now, the top 10 holdings in the S&P 500 takes up about 34% of the entire index. This is way higher than anything that we have seen in the last 50 years. Not just that, the top 10 stocks are also trading at a PE ratio of 30 times, which is much higher than the rest of the 490 stocks in the index, which only has an average PE of 18 times. Now, of course, we still aren't at the 2000 dot-com bubble level yet, but their PE is still pretty high nonetheless. And some people believe that index funds are the reason behind this over-concentration. For example, if you open up Apple's shareholder list, you see that the top shareholders are fund managers of those index funds like Vanguard, BlackRock, and State Street. And together, just these three names alone hold about 18% of the company's shares. Here's Microsoft, and you will see the same names again. And no matter which stock you look at, the top holdings are usually the big fund managers. Quick pause. If you are looking for a low-cost broker that offers competitive pricing and a whole lot of other innovative features, you can check out the latest brokerage in town, Longbridge. With Longbridge, you are able to trade across Singapore, Hong Kong, and US markets with fees starting from as low as $0.008 per share, with a minimum of $1.98 per order. Whether you are just starting out or a seasoned investor, Longbridge has something to offer to everyone, from user-friendly interface, free real-time data, to company research tools, latest news, and advanced charting tools. If you are looking for quick, comprehensive answers, you can also check out Longbridge Pod AI, the industry's first financial GPT, to help you with various financial queries. New users who fund your account, trade, and fulfill the respective criteria will be eligible to get up to 760 Singapore dollars worth of rewards, plus an extra 18 Singapore dollars cash reward when you use my exclusive link to sign up to Longbridge. And with that being said, let's get back to the video. Michael Burry says that because of passive investing, price discovery has been removed from the equity markets. The simple thesis and the models that get people into sectors factors, indexes or ETFs and mutual funds mimicking those strategies. These do not require the security level analysis that is required for true price discovery. What he means is that because investors are passively investing into these index funds, more and more money is being blindly invested into these companies, not because of companies' performance, but simply because they are in the index. And over time, this could lead to overinflation of the stock price, or a stock bubble. A stock bubble is formed when the value of a stock rises far above its fundamental value by a large margin. This happened during the dot-com bubble in 2000, where investors were rushing in to buy up all the tech stocks and push stock prices far above their valuations. This was of course unsustainable. Eventually, the bubble burst and there was a huge market correction. Besides that, Michael Burry also pointed out that half of the stocks in the S&P 500 have small trading volumes, but because of passive investing, trillions of dollars are invested into these stocks. This is similar to the theater, which keeps getting more and more crowded, but the exit door is the same as it always was. And if everyone tries to sell their index funds at the same time, there would be a big crash in the share price because there won't be enough people to buy the stocks. So, how true are these theories? Let's go through them. Now, even though the S&P 500 is getting top heavy and their PE are high, the good news is that all these are well supported by the company's earnings. Throughout the entire year, the Magnificent 7 stocks had higher profit margins than the rest of the stocks. Likewise, the Magnificent 7 stocks had been delivering higher earnings as compared to the rest of the stocks, which had lower earnings growth. For example, back in the first quarter of 2024, the Magnificent 7 stocks had earnings per share growth of 50%, while the rest of the S&P 500 stocks saw an average growth of -2%. And it was only in the latest fourth quarter that the rest of the stocks started delivering better earnings growth. This is also the reason why, as interest rates are coming down, investors are also starting to move away from just the top few stocks which are highly priced and are instead looking towards investing in other stocks that may offer better value. This is also known as the broadening of the stock market. As a result, the rest of the stocks are starting to play catch up. Here, you can see that the rest of the sectors have been outperforming the Magnificent 7 stocks since the middle of this year. Besides that, Vanguard found that over 90% of the ETF trading actually takes place in the secondary market. Basically, this means that when investors buy or sell ETFs, they are usually just trading among themselves. This trading activity does not actually impact the prices of the underlying stocks in the ETF. So, think of it like a second-hand market where you are buying and selling stuff with one another, but the original item's prices are not affected by your trades. This contradicts the idea that a huge amount of money is flowing into passive funds and inflating stock prices. But what about the remaining of the 10% of ETF trading which takes place on the primary market? The investment company Institute found that the process of ETF creation and redemption only makes up less than 5% of shares trading activity. And despite the huge inflows into passive index funds since 2008, the share of primary market trading has only increased by 0.7% between 2010 and 2019. BlackRock also had a similar conclusion where they found that passive index funds contributed to less than 5% of individual stock trading. Instead, they found that the bulk of trading volume is still done by active stock selectors, where for every $1 traded by index managers, roughly $22 is traded by active stock pickers. This finding is also supported by the fact that when a stock is added to or removed from the S&P 500, we don't see any long-term effect on the share price. For example, before a stock is added to the S&P 500, the stock price tends to rise prior to the addition, but after 1 month, the price comes back down to its original level. The term for this is called the S&P 500 effect, where buying activity tends to rise prior to the inclusion of the index, but the increase is mostly temporary and will settle down after it's added in. Similarly, before a stock is removed from the index, it first drops but quickly recovers back to its original level. So even though passive investing is getting popular, it's still nowhere to overtaking the entire market. In fact, earlier this year, Morningstar found that both the active market and the passive market have almost the same market share at $13 trillion each. But here's a question. What if one day passive investing does eventually takes up 100% of the market share? What will happen then? In theory, this will lead to no more new investors left to change the relative valuation of securities because everyone would be buying the same stocks with the same allocation each time. So everything would rise together. But in reality, active traders who are good enough will then be able to look for undervalued stocks and beat the market. And as more and more active investors do that, it will reach a point where it again shifts back to passive investing. But let's be real here. I'm not saying that there is zero risk in an index fund. Nothing in the market is ever completely risk-free, yeah. But here's the thing, the market is not going to crash just because passive investing has become popular, but rather passive investing still remains one of the best ways for most investors to invest and grow their money. Anyway, that's all for this video. Hopefully you found it useful. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.